Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Well, a strong market rally has propelled a nice gain in some of the FANGs, as investors continue to hope that the group has fallen far enough so that it now represents something approaching a value proposition. In response to that hope, we would look at the fair market value measure of most of the FANGs. Only 2 of them have positive fair market value, and of the 2, Alphabet is very marginal. We reviewed events in the NASDAQ in the 2000-2002 market setback and found that until the high-techs and other NASDAQ stocks showed positive investment values, the NASDAQ did not find its ultimate low. What did stand out was that there were several promising trading rallies on the way down, some quite sizable. And we can certainly see where they are likely to fall this time around. Right now, the major staff cutbacks at Amazon and Meta, Amazon in particular, may be speaking volumes not only on the outlook for the business of these companies in particular, but also for the overall economy in general. The question on the floor is, therefore, what must lie ahead for the overall markets? However, more details on that when they are clearer to users of SVA, so stay tuned. We have a strong community of investors who use our service to better understand the market, but also to approach the market with greater confidence. This is especially true in our current uncertain markets, where the stakes are much higher than before. If you would like to join us, we are offering an exclusive offer to try out our service at a reduced rate. Go to www.strategicanalysis.ca/pricing and take advantage of this limited time offer by clicking on Insight Edge. When you sign up, you get immediate access to our database of almost 3,000 proprietary SVA charts, along with all of the included service features, plus an electronic copy of my book, Inside the Market, that explains how the SVA methodology works. Furthermore, all new clients get a personal and exclusive one-on-one session with me that usually takes an hour or so, where I will go over how to use the system to help improve your returns. But please note, in the interests of full, plain, and true disclosure, SVA is a do-it-yourself investment service and is therefore not for everyone. It does take some time and effort. But those who really want to learn how to use it and are ready to take that next step, it can prove to be a tremendous benefit to your investing future, as I hope I will show today. Let me add that if you want to learn more before you actually join us, this coming January, I will be conducting a free and public, full-scale, hour-long introductory webinar that outlines our service and the underlying methodology that you can attend live. You will need to sign up to reserve your spot, as enrollment tends to get filled up pretty quickly every year. We'll be announcing how to register shortly, so make sure you're back here so that you do not miss out when we open registration. Now, before we take a close look at those FANGs and what's going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. We will start with Amazon, the company that just announced a massive layoff, both in the United States and Canada. The stock has broken down below its bubble price, which marks a long-term low going all the way back to when the company was first listed. So this is a serious signal in SVA and tends to tell us that there is a lot of downside ahead. And of course, you can see from the trend of the fair market value that it is actually pulling the price, the valuation down with it. The other stock that has had announced massive layoffs, some 11,000, of course, is Meta. Well, the problem with Meta, or maybe what's good with Meta, is that the stock has already fallen some 73%. We had a sell signal, you remember, at its bubble price, where it had hit 3 times prior to that, and it has fallen all the way from 7.4 times book down to its growth price, or 2 times book, before finding its feet and having a bit of a bounce. The only weakness that we see, however, of course, is the downtrending fair market value. Tesla is kind of looking as if it's walking downstairs. It's HB4 to HB5, HB3 to HB4, and now HB2 to HB3. And today, Tesla just hit a new low. Now, it hasn't broken its HB2 yet, but given where the fair market value is, it may well do that and continue that downward stepping stone. Apple, hard to say what to say about Apple. I think if we look at the continuation of that downtrend due to stock buybacks, the stock actually hit it's HB6, which is a 33 times book value, before rebounding. But you'll notice that the rebound has been fairly tepid. Microsoft, well, starting from our sell late last year at the HB3, which is 12 times book, that's 16 times book, down to its HB1, which is 10 times book. The stock continues its downward trend, and look at that, the fair market value is failing as well. Now, it's had a rebound back to its HB1, but there doesn't look to be much, if any, follow-through at all. NVIDIA, on the other hand, actually has enjoyed quite a strong rebound. And indeed, we now have a new, see that? We've got a new balance sheet for the company. And so what we now see is, in retrospect, unfortunately, that the stock actually has fallen to its HB2 price, which is 12 times book value, before a rebound. And actually, it bounced all the way almost back to its HB4 price, which is 20 times book value. So that is quite a strong bounce. However, what I notice is that the fair market value continues to fall, and indeed that is the case throughout the semiconductor industry. Alphabet has had a nice little pop. It's now struggling, I think, to hold at its LSG price, which is 4.5 times book value. I continue to think that the stock is going to head down to its super growth price, which is 3.5 times book, because that is the long-term fulcrum price going back some 12 years. And of course, its fair market value is sliding as well. Finally, Netflix has, it's kind of toyed with me a little bit. Usually when a stock breaks its bubble price, I've noticed in many cases, it will then tend to fall to its super growth price, which is, so that's 7.4 times book to 3.5 times book. And this, of course, is what Amazon is doing right now. It's just breaking. Well, once the stock gets down there, very often what I have noticed is that the stock will actually recover, almost or to back to its bubble price before continuing its downward journey. Remember that a break of the bubble price tells us that the hyper growth condition of the company has now changed for a much slower rate. And the question is, how much slower? Well, we can see that that continues to slide. Now, the stock had broken down last week, but had made a recovery. Maybe we'll still get there. In summary, the rally in the NASDAQ has been far less dynamic than the rally in what are called value stocks. The NASDAQ has only gained about 10% versus, for instance, the Dow 30, which has improved by some 17%. This is highly reminiscent of the collapse of the high-tech stocks in the 2000 and 2002 market, and suggests to me, at any rate, that history both repeats and rhymes. Until the NASDAQ offers good investment value again, it is difficult to wax poetic for the long term about almost all of the FANG stocks. My message is that there will be good trading opportunities ahead, and you'll need to stay in touch with the values here, especially the values in the NASDAQ 100. But we are talking about trading values that lie ahead, not investing values. The rally that we saw developing last week expanded into some decent recovery gains for some of the FANG stocks, even in the face of very poor numbers and mass layoffs. Whether this psychology will prevail for much longer is an open question, and more to the point, can this optimism prevail in the next 2 to 3 quarters if current earnings and fair market value trends persist? As I said previously, big tech was bound to start missing earnings, having grown too large to be immune from a slowing economy. This earnings season has proven to be the case, with Amazon, Microsoft, Alphabet, Meta, Netflix, and Nvidia, all with disappointing earnings and/or guidance. Only Apple and Tesla are without major disappointment, at least so far. The challenge, as I see it, is that their fair market value measures are so far below their price and price-to-book valuation. Amazon has given us what I call the death cross when it failed to hold its bubble price, and I would not be inclined to be long the shares here at all. Microsoft and Alphabet are clearly heading lower, with disappointments showing the way down. Meta is the most intriguing of the FANG stocks today. It's already fallen in hard times, down 73% top to bottom, after my sell signal last year. But on the positive side is one of 2 FANGs with positive fair market value, that is, intrinsic potential as we measure it, albeit that the fair market value is heading sharply lower. The question is, can we trust Zuckerberg to give up his metaverse dream? Or, as my father used to say, is he going to continue to pound sand down a rat hole? I had hopes for Netflix after it fell to its very, very long-term valuation low, its super growth price, or 3.5 times book, and had a beautiful rebound. I had thought, hoped, and maybe still do, that it could go all the way back to its bubble price, as many failed hyper-growth stocks do, as they slowly turn into just growth stocks, and sometimes not even that. Tesla is trying to hang in above its HB2 price, but I am not sensing any conviction these days. If you'd like to remain positive here and buy shares when it falls to its HB2, that's 12 times book, be my guest, and you may prove to be right, at least for a while. As far as Alphabet is concerned, I expect that the super growth price, 3.5 times book value, is where the shares are going, and I would be very surprised if there were not a decent rally at that point. Apple seems to be everybody's favorite stock, and their share buyback program is what is keeping the stock valuation higher than it actually merits. I may not care for the stock at these extreme levels, but I certainly do not fight City Hall. And Apple has been probably the best performer of all the FANGs. Microsoft, and NVIDIA in particular, had checked back up towards their key breakpoints after breaking down below them. But as I said, I would not reverse my sells on both stocks, certainly for now. I was particularly keen to see the new Apple balance sheet, and they have continued to buy back stock. Their return on equity continues to rise, keeping the stock valuation and price to book terms rising as well, although price is another issue. I've never been able to pull the plug in this stock, and that's the reason why. I may not care for it, but I don't fight City Hall. Lastly, I am concerned that with Amazon letting go, it may be a key signal concerning the rest of the NASDAQ 100 growth stocks. The NASDAQ 100 has a very weak negative fair market value potential of minus 26%. Albeit down from minus 60% last November. Maybe all it needs is a little downside leadership to keep that index heading lower. So lots to keep in mind this week. As we've seen over the past 3.5 years of our FANG Friday telecasts, these behemoths have provided many opportunities to trade, both on the long and the short side, and nothing has changed this week. There's more to do, and there's more to do right now. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and the senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you